DoubleLine saying the risk and investment grade corporates going forward is balanced, running the following. Valuations are stretched and there's a lot of political risk out there. Spreads could go out 25 to 50 basis points, but at that point the Fed will just pick up its buying. Don't want to say that everything is rosy, but at the time it's about risk reward, and the Fed backstop changed the landscape. Monica Erickson joins us right now. Monica, lucky to have you with us this morning. Let's just start with the issuance and the amount of supply that we've had. Any signs of fatigue, indigestion whatsoever from what you're seeing?
Well, thanks for having me, and I like the intro. You basically have covered everything I was going to talk about. But yeah, it's been really amazing to see the amount of new issuance, and it really started on March 23rd when the Fed came in and really changed the entire landscape for the asset class with their two different programs that they've put in place. And so as of right now, the Fed has two separate programs, $750 billion in total to purchase investment grade corporate bonds. They've only purchased $12 billion so far. So it's more of a signal that they've sent to the market that there is a real backstop that they will support the market. And since then, we've seen over $1.5 trillion of new issuance. And like you stated, their companies are now coming to market just because financing is cheap. The first round of financing we saw was really companies coming to market that wanted to shore up liquidity because there were so many unknowns in the market, and they were paying down revolvers, really just stretching out their cash flow, giving them the cash on the balance sheet that they needed to weather what was a kind of an unknown economic situation. And now, to your point, they're coming to market just because financing is cheap. One thing I would note is we are seeing a lot of tender offers, which is very interesting, even although I think with this Apple deal today, it's very much just opportunistic. Yeah. Yesterday, we saw CVS come to the market, and they issued a little bit less than what they were tendering for. So it's really, really amazing just to see the amount of new issuance in the investment grade corporate market.
Monica, I'd love your thoughts on a big tech company coming out with very long dated debt. For some of these companies, they didn't exist 10, 20 years ago, but Alphabet is out with a deal in the last couple of weeks with a 40-year maturity. Monica, I just wonder how you yourself approaches a situation like that, a tech firm with really long-dated debt at incredibly low yields?
Well, I think the 30-year paper has been out there. 40-year has become a new issuance, and in reality, the difference between a 30-year and a 40-year is not all that different. I think that investors look at it, not that they're going to be invested for 40 years, but what's going to happen over the next 6 months, 12 months, and that depends on where interest rates are going, where spreads are going. So it's not a 40-year outlook when you're looking at a 40-year bond.
It just feels like the IG market is the new Treasury market, Monica. I've had so many people come on this program talking about Treasury replacement because yields are so low. There's an asymmetric payoff. That's what Bridgewater told us on this show last week. Monica, how do you view that, the IG market, and how the characteristics might have changed in the last few months?
Sure, and it really goes back to what the Fed is doing in this market, and frankly, across a lot of other markets as well. You look at it to see how much treasuries have been bought over, I think, close to $2.5 trillion this year. So it's I think that it's really supported by the Fed. It comes down to that. There really is not a real price discovery right now. It really doesn't have a lot to do with fundamentals. It has to do more with what the Fed is doing with the market. So my view is that I think, spreads have obviously come in significantly since the Fed stepped in. I think that there are risks out there, so we could see some spread widening. But I think that the risk is really balanced because we do have this Fed support. And in fact, the program that they have in place was supposed to end at the end of September, and they've extended it through the end of the year. And my guess is that if they need to extend it further, they would do that. So it really comes down to the Fed right now.
Can you walk us through how the playbook has changed for you and what you used to rely on and now need to ignore, and how difficult that's been, Monica?
Well, I think what you have to look at is really, you have to look at what is going on in the market, right? You have to, right now, what I am seeing is there's a lot of demand for investment grade corporate credit. It's coming both from the retail investor, so you see mutual fund flows. It's coming from overseas. I think you mentioned just the low yields in the Eurozone. I looked at it yesterday, and something like 20% of the index there trades at negative yields. So for foreign investors, the U.S. market looks very attractive. So there's really, you have to look at the technicals, not just the fundamentals, because right now the fundamentals are not what is driving the market.
What would be the conviction trade for you now, Monica?
Well, I think I'm a little concerned about taking duration risk. I know that has been what has worked this year. But if anything, I would be more interested in taking on more credit risk than duration risk.
Is there a sector bias there?
No, I think we are balanced in what we're investing across tech, across pharma, which are the more defensive sectors. We're also looking at sectors that have been hit hard by the pandemic. Travel-related sectors. There are investment grade companies that are in those sectors that are going to be survivors and where there's opportunity. So it's really a balance, and we're not overweight one sector. It's credit by credit, looking to see what companies are going to be able to weather this drop in economic activity.